Okay, so it is 1 minute past 11. Again, please allow me to thank everyone who made it to this member survey press conference. My name is Craig Allen, and I am the president of the US-China Business Council. And it's a pleasure to be with you again this year to present the results of our member survey. The US-China Business Council is an organization of over 270 American companies that do business in China. Many of these companies are Fortune 500 firms, and most of them have very significant investments in China. 2022 is a politically sensitive year for both countries. In November, there will be midterm elections in the United States, which will determine the ability of the Biden administration to advance its agenda for the second half of its term. And around the same time, China will hold its 20th Party Congress, where Xi Jinping is widely expected to take a precedent-breaking third term. This has created an environment where neither side is readily able to make concessions to the other. In the US, while the Biden administration has doubled down on domestic investments to outcompete China, there has been a little movement on trade policy, and billions of dollars in tariffs remain in place, despite the fact that they serve no one's interest. In China, the continuation of stringent COVID control policies as the virus has evolved has become very costly to the Chinese economy and to US companies doing business in China. Lockdowns forced companies to shut down for months and created significant uncertainties for business. And many US-based executives have been unable to visit their China operations for several years now. At the same time, the geopolitical environment is becoming more complex, making US-China relations more tense and thereby increasing risk for American companies. After this year's important political meetings in the US and China, there will be a critical time for both countries to come back to the table. Neither government should take for granted the economic relationship nor the stabilizing role that trade and commerce and economics play in US-China relations. So let me go on to the key takeaways for our survey. Our annual member survey takes the pulse of US business in China, unpacking the most significant challenges that US companies face there and exploring how these impact their performance and planning. Data for this year's survey was collected in June, shortly after the widespread COVID lockdowns across China, most predominantly or prominently in Shanghai, and of course, after Russia's invasion of Ukraine. So please allow me to introduce some key takeaways from this year's survey. Number one, China's dynamic zero COVID policies are the top challenge. China's COVID-19 strategy now poses a top challenge to US companies, displacing US-China relations, which ranked as the top concern for the last 4 consecutive years. The looming possibility that companies will again be forced to partially or fully halt operations due to lockdowns and have impacts, and the impacts of local controls on consumer demand have undermined business confidence in the overall business environment in China. The number 2 takeaway is that bilateral relations continue to hurt American companies. Respondents report record high concerns with US-China relations, which continue to deteriorate. Geopolitical pressures are bleeding into the commercial realm, leaving companies which depend on a stable and predictable trade environment in increasingly challenging positions. Chinese customers' real and perceived concerns about ongoing access to US technology due to US-China tensions continue to threaten US companies' competitiveness in the market, an alarming trend that could be difficult to reverse. Our third key takeaway is that there has been little progress on long-standing issues as new bilateral barriers emerge. Significant market access barriers remain, even as China assures foreign companies that they will receive equal treatment in the China market. For example, intellectual property protection has seen some limited improvement. However, there are remaining very large problems. Chinese economic planners have expanded industrial policies to bolster Chinese companies and localization requirements to qualify for state-affiliated procurement. At the same time, new Chinese data security and privacy rules threaten to disproportionately increase costs for multilateral companies. The fourth key takeaway is that the trajectory of commercial relations are at another inflection point, and the environment is uncertain as we peer into the future. The difficult operating and geopolitical environment has impacted company performance, leading to record levels of pessimism and affecting companies' decisions about their supply chains and future investments. At the same time, companies overwhelmingly remain profitable in China, and they continue to recognize China's importance to their global competitiveness. Whether business sentiment and the pace of future investment rebound or continue to falter will depend on decisions made by Chinese and US policymakers in the coming months and years ahead. So with that, I'd like to walk you through our survey's main findings, and then I'm happy to take your questions until about 11:50. At that point, I will have to withdraw, but my colleagues can stay on a couple of extra minutes. And we're happy to take your questions by email if you have more detailed questions that you would like us to look at. But before that, let me say a little bit about the data and the respondent profile that we're about to review. This year's survey draws from a pool of 117 member companies, nearly half of USCBC's membership, and a similar participation rate to past years. Most respondents are large US headquartered multinationals that have operated in China for more than 20 years. 40% have over $1 billion in revenue in China. Respondents were evenly split between manufacturing and services, both representing about 39%, with 14% in primary industries and close to a quarter characterizing their operations as technology intensive. So every year we ask our members to rank their top challenges in China. This year, the challenges can be divided roughly into three somewhat overlapping categories. The first category is COVID control policies. Here, you'll see number 1 and number 3. The second is US-China relations, which I would characterize as number 2 and number 6. And the third are China business environment and policy questions, 4, 5, 7, 8, 9, and 10 in ranked order. So today I'll run through all of these challenges and then discuss how these have impacted company performance, sentiment, and investment planning. So let's go on to COVID policies. I'd like to begin by discussing how China's COVID control policies have impacted companies. 2 of this year's top 3 challenges, lockdowns and travel restrictions, are related to China's dynamic zero COVID policy. And I'd like to share some data points on just how deep the impact has been. As many as 96% of respondents have experienced negative impacts on their China business, with nearly half reporting severe negative impacts. Over half of respondents paused, delayed, or canceled investment plans in China because of China's COVID-19 strategies. Some of these investment that have been foregone are quite large. COVID measures impacting plans for over $10 million in investments are reported by a third of the companies. Even if China changes course on its domestic COVID policies, 44% of respondents say it will take years to restore confidence. Interestingly, respondents reported that the top challenge from COVID is political risk. And I think that I would interpret that as meaning that the Chinese government is willing to pay a high economic price to maintain its zero COVID policy. And we do not know how long this economic price will continue to be paid. For how long will these policies continue? And what are the threats of factory lockdowns and market disruptions for how long into the future? We simply do not know. There's a lot of data there. Take a look at it at your leisure. Let's turn now to US-China relations. This year's number 2 challenge was US-China relations, indicating that this remains a top issue for US companies doing business in China. US-China technology decoupling is 6th among the top challenges, demonstrating concerns around issues such as export controls, sanctions, and proposed outbound investment screening measures, as well as China's technology self-reliance efforts and nascent sanctions and export control regimes. So 87% of our companies have been affected by US-China tensions. And that is a very large number. So let's look at some of the detailed responses. As in past years, the top impact of US-China tensions is lost sales due to uncertainty of continued supply, which is impacting nearly half of respondents. 1/3 of companies also are concerned about the impacts of Chinese nationalism on consumer decisions, also similar to last year. A third bucket of challenges has to do with China's business and policy environment. As new policies make China a more difficult place for foreign companies to compete, long-standing issues remain. There have been some major changes in this part of our survey, and I regret to say that the environment appears to be getting worse. At least that is the perceptions of our members as expressed in this survey. So we could start out with the data and privacy rules. This year's number 4 challenge was around data, personal information, and cybersecurity rules in China, as China has rolled out its key legislation governing these issues. This year, a record high of 87% of respondent companies report concerns with Chinese policies and regulations governing information flows and technology security, with an increasing number of companies report that they are very concerned about these policies. You'll see here 27% in 2020, 31% in 2021, and 39% in 2022. Companies report that restrictions on cross-border data flows, data localization requirements, And the ambiguity or vagueness of compliance requirements are their top concerns. These concerns have been fairly persistent since 2015, when the first draft of China's cybersecurity law was published. That said, companies are beginning to experience more tangible impacts from China's data policies. When asked this year about whether concerns about data policies were based on existing or potential impacts, more than a third of respondents said existing impacts, up from only 20% before. So as the policies are coming into force, the concerns about them and the expense of meeting their regulatory requirements are increasing. And I'm sure that this is true across the board, not only for American companies, but probably indeed for all companies. But we should also talk about domestic innovation policies, protectionism, and state support, because these this subset of policies disproportionately affect foreign companies. China uses a range of policy tools to promote industrial development, which can become an issue for foreign companies in the market when they are used to shield domestic Chinese firms from competition. Asked about what signs of protectionism they are seeing in China, 46% of the companies name national policies promoting domestic innovation and technology self-sufficiency. That is a very large number. Other top issues include negative media coverage in China amid growing nationalist sentiment and licensing and regulatory approval processes. More than 37% of companies report that they are negatively impacted by China's industrial policies, with the top impact being increased competition from Chinese companies that were previously uncompetitive. Other issues include limited access to specific sectors that are prioritized in industrial policies, and Chinese consumers moving towards domestic alternatives to products that are made by foreign companies. So this is an important graph. I'm happy that the numbers that say report a negative impact are not increasing, but the numbers here represent severe concern for many American companies, and this is worthy of close scrutiny. We see that China's domestic industrial policies may have had impacts on US companies' global competitiveness. Companies were asked if they are concerned that China's industrial policy will hurt their market share both in China and globally. In China, between 59% and 66% were concerned about the impacts depending on the time frame. So over the longer term, people were more concerned. Over the shorter term, less concerned. While fewer companies were concerned about the impact that China's industrial policies will have on their global performance, still, these numbers are larger over the longer term than they were over the shorter term. Again, indicating that China's industrial policies have an impact not only domestically in China, but potentially on a global basis. Let's take a look at government procurement. Although the Chinese government has made steps towards more equality in government and procurement, Buy China policies are still causing great difficulties for foreign firms. Just over half of foreign companies report that China's government procurement market for foreign companies have deteriorated, and only 6% saw an improvement. This is a huge concern, and these numbers indicate that while the rhetoric has been positive, many specific procurements on the ground are problematic. Companies see the main challenges around government procurement coming from non-public directives that require purchasing domestic products, unfair treatment of imported products, and a murky definition of what exactly constitutes made in China or guoqian. The definitions there are not fixed. So there remain very significant concerns about government procurement policies, which cover a large segment of the total Chinese GDP. And these are areas where we would like to see considerable improvement in the future. Let's talk about intellectual property. Intellectual property protection has been a long-standing issue for US companies in China. While this concern has dropped from the number 6 priority to the number 10 priority this year, the percentage of respondents expressing concerns has remained consistent, implying that companies aren't less concerned about IP, it's just that they're more concerned about other more urgent and demanding priorities. Although a majority of companies feel that China's IP protection has improved, at the same time, 89% still report that they're still concerned about IP protection in China, and that number is far too large. Respondents note that the level of Chinese IP rights enforcement has very negative business consequences. It pushes them to limit their R&D activity in China, up to 50% limit their R&D activity in China, limit what products are made in China, and limit what products are licensed or co-manufactured in China. And thus, this is another area requiring urgent attention. Let's talk a little bit about technology transfer concerns. Technology transfer is an issue for a relatively small group of companies, but a particularly acute issue for some of the companies affected. This year, 14% of respondents are reported to being asked to transfer technology in China. And that is a much smaller number than it was 5 years ago, but it is still a concern. And I'm happy to talk about that in more detail if you would like. We've discussed the challenges, but how is this then impacting performance, sentiment, and planning? Although the vast majority of companies in our survey report their operations are profitable, the percentage of profitable companies, 89%, is the lowest recorded in our survey in 7 years. Companies, unsurprisingly, list COVID-19 as the top restraint on profitability in China, following by competition from domestic firms and Chinese policy and regulation. Despite signs of weakening performance this year, 2021 was a strong year for most respondents. 63% report increasing profitability last year. 4/5 report that their China profit margins were the same or better than their overall operations last year. This record underlines the importance of the China market for US companies. If companies are unable to participate in this market, it will put them at a global disadvantage compared to competitors that are able to participate in the market. Let's talk a little bit about sentiment. Amidst COVID lockdowns and a challenging geopolitical atmosphere, optimism about the China market has taken a sharp dive this year. Companies expressing an optimistic outlook have fallen by 18% to a record low of 51%. Pessimism, on the other hand, is at an all-time high of 21% of respondents, more than twice last year's figures. Looking at this over the last decade, optimism has gone from nearly 50%, from nearly 90% to just over 50%. So this is quite a stark decline. Now, I should remind people that the survey was taken in June in the midst of the lockdowns, and that may color some of the sentiment here. But asked about what issues are driving this decline in optimism, the largest response is that of geopolitics, with at 73% of respondents. Following behind are the policy and regulatory environment and the underlying landscape of China's slowing domestic market growth. While comparing the business climate in China to 3 years ago, 83% of respondents report that they are less optimistic, a 24% increase from last year, and a 42% increase from a decade ago. So this graph should be a cause of concern for those that wish to promote additional U.S. investment in China. So let us look at the future plans of our respondents. Perhaps unsurprisingly, we see this growing pessimism also reflected in questions about investment planning and future resource commitment. Around a quarter of respondents plan to accelerate their resource commitment in the China market in the next year, half of the proportion of 5 years ago. Compared to last year, the number of companies planning to curtail their resource commitments in the market have more than doubled from 6% to 13%. The majority of respondents are taking 62% are taking a wait and see mode, however, choosing to wait out uncertainty surrounding China's COVID-19 policies and bilateral tensions. Maybe they'll make these investments, maybe they won't. They're just going to wait and see. We saw a similar reaction from companies at the beginning of the COVID-19 pandemic in 2020, which was followed by a bounce back of investment in 2021. But in 2022, we go back to increased uncertainty. How US companies choose to invest in China moving forward will likely hinge on China's policy choices through the end of this year. As an indicator of whether China's companies are likely to make further investments in China versus other markets, it's useful to look at the level of priority companies put on the China market compared to other markets. While China remains within the top 5 priorities of 77% of our respondents, this number has declined consistently over the last decade, at the beginning of which China was a top priority for nearly all, 96% of respondents. And companies indicating that China is their top priority market has fallen to an all-time low of 6%. To understand why companies continue to prioritize the China market, despite the COVID and economic pressures, it's helpful to look at why they invest in China. 83% of our members indicate that they are in China to access or serve the China market. China's large and growing middle class still represents an important opportunity for companies over the longer term. And to be competitive in the China market, it is important to be close to both suppliers and customers. Let me say some words about supply chains. I wanted to touch briefly on this. Most respondents are not moving their supply chains out of China, which speaks to China's competitiveness in speed, quality, quantity, and the cost of manufacturing. However, the increasingly challenging environment has also caused companies to reconsider their supply chains. Over the last 12 months, nearly a quarter of our respondents have moved segments of their supply chains out of China, a significant jump from last year. And the majority of those doing so are moving to locations other than the United States. The top reasons cited are really not tariffs per se, but they are the COVID-19 shutdowns in China and supply chain resilience. So to wrap up, and before I take your questions, I'd like to say that the data in this year's survey foreshadow major headwinds for US companies operating in China. But this hardly means that these trends are set in stone. Chinese government is very tactically flexible and indeed changes policies frequently. Our data also shows that business sentiment and investment plans have bounced back from challenges in the past. China remains vital to US companies' global competitiveness, and our members are in China for the longer term. The future trajectory of US-China commercial relations depends on the choices of the US and Chinese government policy makers. And to this end, we have some recommendations. We urge China to take bolder steps to balance pandemic control with economic growth. We encourage China to move proactively to level the playing field for foreign businesses by improving market access and limiting distortive industrial policies and government procurement policies. We hope that both governments can adequately but narrowly scope national security issues to avoid unintended consequences to normal trade and investment activities. We believe both governments should also look for areas of cooperation, particularly in areas associated with global public goods, such as climate and public health. And to facilitate progress in these areas, we recommend that both governments immediately begin exploring expanded opportunities for constructive, results-oriented dialogue on commercial issues and global public goods while continuing to manage geopolitical and bilateral tensions. And with that, I am pleased to take your questions. And joining me now are my colleagues, Jack Kamensky, who worked very hard on this survey and is really the architect of the survey, and Rory Murphy. So Jack leads our business advisory services, and Rory, who is off camera, our government affairs team. While I'm at it, I also want to thank, there he is. While I'm at it, I also want to thank Ian Hutchinson, who did a huge amount of work on putting the data together in a comprehensible and easy to understand form. So with that, let's take your questions. I would welcome you to put questions in the Q&A box. Or to raise your hand either way. I see that we have something in the Q&A box, and so let's start there. But in the meantime, I welcome additional questions. So let me read it out for everyone. Nearly a quarter of US companies surveyed have moved some of their supply chains out of China, according to the data. However, according to the Chinese Ministry of Commerce, US investment in China increased by 36.3% in 7 months of the year. Why are the results of the empirical survey inconsistent with the macro data? Great question. There is an apparent inconsistency here, but I think that it's relatively easily explained. Firstly, I would note that investment data is usually not of the highest quality. So I'm not going to comment on MOFCOM data, but their notation that overall US investment in China grew last year, I think it is almost certainly correct. 36.3%, that sounds high to me. But much of that were in ongoing projects that have been going on for years and years, and many of them for very large projects, which continue to roll on. There's also a lot of investment in China from retained earnings. And that's very consistent with the fact that almost all of our companies, 83%, are in China for China, and they believe that the China market is growing. Now, the fact that a higher percentage of our companies are moving supply chains out of China is not inconsistent with that at all. In terms of companies might be moving, say, final assembly out of China. They might be moving the labor-intensive part of their product outside of China to a cheaper location, or they might be moving a technology-intensive part of their supply chain out of China and putting it someplace else. So the investment numbers are very large, and these supply chain numbers are really at the margin, right? And that's a key thing to remember. There are always changes in marginal changes in supply chain, and that's ongoing. And COVID restrictions have definitely impacted that. Companies are very concerned about having a single point of failure in China, particularly when, due to COVID, their factories can be closed down in an unexpected and unpredictable manner at any time. So COVID is the main factor there, but COVID has not stopped the longer-term investment plans. Let's go on to the second question. On Monday, Chinese Premier Li Keqiang at the State Council meeting said that the government had launched more policies to stabilize the economy this year than it did in 2020. Last week, the government also revealed a stimulus package of 146 billion to prop up the Chinese economy. How are U.S. businesses feeling about the receipt of the 146 billion economic stimulus package? Do they view it as enough? I think that we're going to have to wait and see. But that there is a concern about consumer sentiment in China, particularly associated with the zero COVID policies. Due to the zero COVID policies, the Chinese consumer is saving more and spending less. And a lot of the investment monies announced by the premier are going into additional infrastructure investment. And a lot of that has a negative rate of return. Certainly the marginal rate of return is diminishing, if not negative. And therefore, until Chinese consumer sentiment picks up, I think that we're going to remain somewhat skeptical. And so far as we could see anyway, the Chinese consumer is keeping savings high and is spending less. And that will have an impact on the global economy, given that Chinese consumer consumer spending is such an important driver of global economic growth. So sentiment is important here. And I'm not confident that the premier's announced steps, which are important and which will help buoy the sentiment, will be enough to change Chinese consumer sentiment. So let's move on. David, thank you. The results of the survey were taken prior to the latest flare-up of tensions over House Speaker Nancy Pelosi's visit to Taiwan. That is correct. Can you share anecdotal detail on how this has changed the landscape? Do companies see a significant worsening of the environment? I think that the answer there is complex. What our survey notes is that many companies are concerned about increasing nationalism in China and negative press reflections on the United States, if not on American companies, that are increasingly common in Chinese media. we note with concern that a very large percentage of the Chinese public does not look at the United States favorably in public opinion survey polls such as Pew. And so therefore, we are concerned, I think legitimately, about increasing nationalism and the perceptions that American products may be less reliable than foreign products. So there's two elements to that. There's a consumer side, which is very important, given that Chinese make up 19% of the global population. But the other element of that is that Chinese tech companies, for example, are concerned are concerned about American sanctions and export control policies, and American companies on the tech side may be discriminated against in future planning or public procurement on the grounds that due to export controls and sanctions policies, that they might not be reliable in the future. We have some reports that American companies are being asked to sign statements that they will not become subjects to export controls, and that's not something that they're legally able to do. So those types of risks of nationalism and concerns in the tech community and the industrial community about deteriorating bilateral political relationship, both of those are real, and they affect the market in different ways. They both have an impact on sentiment and perhaps even on future investment plans. So those are all great questions. I would welcome anyone to raise their hand or to ask other questions.
Yeah, Craig, if I could step in. Speaking of raising hands, I see that Phelim Kine from Politico has had a hand up for a while. So Phelim, I did just invite you to speak.
Please forgive. How are you?
Able to unmute and ask your question directly.
Hi, good morning, everybody. Good morning, Craig. Thanks, everybody. Appreciate it. Listen, quick question. To what extent is the USCBC and USCBC members looking to the conclusion of October's 20th Party Congress and a likely Xi Jinping third term as an opportunity for Chinese authorities to address those top irritant issues that this report outlines? Is this something that people are even thinking about and hoping for? And if so, what would be like maybe the lower hanging fruit that they think could be addressed in the short to medium term with a firm Xi Jinping third term in pocket? Thank you.
Well, I think that as the two leaders prepare to meet in Bali at the G20 on about November 12 or November 13, or in Bangkok at APEC on or around November 15, that we're hoping for a stabilization in the overall political relationship and an agreement that trade, economics, science, climate change, public health are good for both sides, and that business should not be unduly impacted by the bilateral tensions, because it's not in the interest of the people of either the United States or China. So the 20th Party Congress will be an inflection point. And we will, and I think everyone will be looking with great interest at the Chinese leadership that marches out from behind the curtain as the new portfolios are publicly announced. So, of course, this is important. In terms of low-hanging fruit, I think that relaxing tariffs, increasing visas, increasing the number of flights between the countries, are things that benefit both sides. Engaging in an active, sustained dialogue on climate change and public health nuclear proliferation, and anti-narcotics would also be a very simple thing to do. And we're hopeful that those will be manifest either in Bali or in Bangkok. Thank you. Ian, do you want to call upon others?
Sure. I see that both David Lauder and Mara Lee have their hands up, but there's also questions in the text box here. So Mara had asked, supply chain resilience is mentioned by those who are considering moving segments, but 26% say US regulator scrutiny is also an issue. So what do you guys hear anecdotally about concerns about goods being barred from entering the US over the Uyghur Forced Labor Prevention Act? And are you starting to hear anything about critical minerals processing given the IRA tax credits for electric vehicles?
Great questions. On the Uyghur Forced Labor Prevention Act, this is the law of the land. And many companies have been, all companies that do business in China have been anticipating this for some time. And it has led to really in-depth surveys about our supply chains and a real ability to document that parts, components, materials are not coming into the United States from Xinjiang. Thus far, there's not a lot of publicly available information on what has been stopped at the border, and we don't really have any quantifiable evidence that there have been major shifts from the previous policy. But we understand that a big, if you will, buildup is underway in regulatory ability. A lot of people are being hired. There's a lot of work going into information gathering and better commercial intelligence. And so I look at this as a rolling process. I have nothing to report of any of our members having problems here yet, but I'm also would note that when customs does make a seizure, there's no requirement to make it public, and there's no reason that we would know anything. But there are no high-profile cases that I am aware of since the implementation of the Uyghur Forced Labor Prevention Act on June 21 of this year.
I might prod. Rory, I know your team has been tracking this as well. Do you have anything you wanted to add there, or do you think Craig covered it fairly thoroughly?
I think Craig covered it pretty thoroughly. I know there was some part of the question related to the processing of critical minerals. I will say that in our conversations with the Hill, that seems to be kind of an area of focus, looking into next Congress. But to this point, have not really seen any legislation that seems to have legs or that we have a position on.
Why don't we take one last question? And I'm sorry, then I'm going to have to leave. But let me reiterate that we're happy to take individual reporters' questions on this at any time. Shoot me or shoot Doug Barry an email, and then we'll get the best person to answer your questions with regard to the survey or anything else. But in the meantime, one last question, Ian.
Yeah, there's one left in the chat box from Ling Xiang. The question is, you said at the beginning that due to domestic reasons, US-China relations are unlikely to see. Yep, can you hear me?
Ian, I'm sorry, I can't hear you.
Oh, can you hear me now?
Yep.
Oh, sorry about that, bit of a Verizon moment. The question is, you said at the beginning, due to domestic reasons.
Ian, I'm sorry, can't hear you.
Maybe someone else can read from the chat box.
Sure. The Q&A. Let me take the last question on the Q&A. I think that, have we covered? Let me take Ma Ling's question. You said at the beginning that due to domestic reasons, US-China relations are unlikely to see any improvement before the end of the year. After the CPC National Congress and midterms election, yeah, I think that we answered that. From Mara Lee, supply chain resilience. Okay, yeah, I think that we've done a pretty good job. Would anybody like to put up their hand and ask a question? I don't see any additional questions. Ian, are we missing anything?
I believe we are set, if you can hear me.
Okay. Well, let me thank everyone for joining us today. Again, after you've had a chance to look through the data, there's a lot of great data there. Please feel free to reach out through Doug Barry, and we will get you an answer to your question. That I can guarantee you. In the meantime, let me thank you all very much and wish everyone a good day. Thank you. Bye.